A tax deduction is an expense that taxpayers can subtract from their gross income to reduce the total amount of income subject to taxation. In other words, it is an amount that taxpayers are allowed to subtract from their taxable income to arrive at their taxable income on which they calculate their income tax liability. Deductions are a way to reduce taxable income, ultimately lowering the amount of income on which taxes are owed. Here's how tax deductions work and their impact on income taxes. Gross income. Tax calculations typically start with the taxpayer's gross income, which includes wages, salaries, business income, investment income, and other sources of income. Adjustments to income. Before calculating the taxable income, taxpayers may be allowed to make certain adjustments to their gross income. These adjustments are often referred to as above-the-line deductions and include items such as contributions to retirement accounts, student loan interest, and health savings account (HSA) contributions. These deductions help in arriving at the adjusted gross income (AGI). Itemized deductions or standard deduction. Taxpayers can choose between taking the standard deduction or itemizing deductions, depending on which option results in a larger deduction. The standard deduction is a fixed dollar amount set by the government, while itemized deductions include specific expenses such as mortgage interest, state and local taxes paid, medical expenses, and charitable contributions. Taxable income. The taxable income is the amount left after subtracting adjustments to income and either the standard deduction or itemized deductions from the AGI. This is the income on which income tax is calculated. Tax calculation. The taxable income is subjected to the applicable tax rates to determine the income tax liability. The tax liability is the actual amount of income tax owed to the government. Key points. Above-the-line versus below-the-line deductions. Above-the-line deductions are subtracted from gross income to arrive at the AGI. Below-the-line deductions, itemized deductions or standard deduction, are subtracted from the AGI to determine the taxable income. Impact on tax liability. Tax deductions directly reduce the taxable income, which, in turn, reduces the income tax liability. The higher the deductions, the lower the taxable income and the less tax owed. Tax credits versus deductions. It's important to distinguish between tax deductions and tax credits. While deductions reduce taxable income, tax credits directly reduce the amount of tax owed. Both can have a significant impact on the overall tax liability. Changes in tax law. Tax laws can change, impacting the availability and limits of various deductions. Taxpayers should stay informed about current tax regulations and seek professional advice to maximize available deductions. Common examples of tax deductions include mortgage interest, student loan interest, medical expenses, state and local taxes paid, charitable contributions, and certain business expenses. The specific rules and limits for deductions can vary, so it's important for taxpayers to be aware of the current tax laws and consult with a tax professional for advice tailored to their individual circumstances.